Hey, hope you're all doing well out there. This is your July market review. My name is Dan Westfall. My company is Client Focus Financial. For those of you that haven't watched these videos before, the reason that I put these videos out each month is to give my clients the straightforward information about what's going on in the stock market and the economy, and then ultimately how that affects their investments that I'm helping manage for them. So this past couple months here, we've had really good market returns with markets moving higher and higher. We're right at all-time highs here as of July 25th right now. We're up over 8.5% on the S&P 500 for the year, which is phenomenal, especially just being a little over halfway through the year. So a lot of people will ask me questions, especially when we get towards all-time highs like this, is that they're fearful that all-time highs means that we're at a top and that we're bound to just go lower, which isn't the case. So if you haven't watched these videos before, I use a lot of charts because, talking about investments and stock markets and economies and all those sorts of things, a little bit of an intangible thing. So I want to put a good visual to what I'm talking about. So I use a lot of charts. And the first one I have here is talking about not fearing all-time highs. So the chart is showing the average rates of return. In the lighter blue, there's investing in the S&P 500 at all-time highs, and the darker blue is investing in the S&P 500 on all other days. So basically when you're not at an all-time high. So if we're looking at this 1 year, fast forwarded, slight difference where it's a little bit, to the benefit to just investing in an all-time high. 3 years looking forward on average, a couple percent better. And then if you're 5 years looking forward, still a couple percent better. So there's not a bad time, while ideally in the best case scenario, you buy in when the market's just crumbled and down dramatically because of some event that's happened earlier this year. We had the announcements of tariffs. Leading up to that, the market was down as much as 19% from its high. That had been a great time to invest. Tough part with that, though, from a human psychological standpoint, is that it kind of goes against our natural instinct, as humans, because when we're looking at an investment, we're really just equating this to our basic necessities: food, shelter, water. And, that's what money is to us. So if we see that our account values are going down, it's not really going to be as exciting to invest, even though that's really the time you want to do it. So still not a bad time to invest, though, when we're at market highs, and that's kind of what this chart here is depicting. So next chart I had going back into a little bit of what I just talked about there with a 19% pullback that we had from March. It was actually mid-February through the tariff announcements in the beginning of April. So this chart is showing the returns for the S&P 500 on a total return basis going back into the late 1980s. The bar graph there in the dark blue, that's the return over the course of the year. This year so far, this was as of July 7th. We were up 7% at that point. So that's only a partial year, but everything else is complete years, obviously. The dots there are the max drawdown. So that's the point from whatever spot during the year we're at a high in that year, and then the lowest point that we're at during that year. So far this year, the high that we had was, it's currently right now, but the high that we had before it dropped was February 19th through, I believe it was like April 8th, right when tariffs were announced. The market had dropped 19% from that peak to the bottom. It's obviously rebounded back to where we're at new all-time highs right now, but that would be what's considered a drawdown. So each year there's always drawdowns to some degrees. Even in lower volatility years, there's still, stocks don't just go up every single day. Even like one of the better time frames, if we're looking to invest, would have been like 2017, when there was barely a 3% pullback from all-time highs that whole year. So not very common for that sort of scenario to happen. So I brought this chart up because I think it's really good, because inevitably, whether it be at some other point this year or into the future, because everybody I'm working with is a long-term investor, we're going to go through pullbacks within the market. And I want you to understand, like, this happens literally every single year. whatever the news event isn't, while the news, if you're watching it, makes it seem like the biggest and most terrifying thing in the world, that's because they're doing a really good job of making you scared, and they're going to sell more ads because they're going to get more viewers watching it. One of the reasons that I create this market review is to cut through that BS, because for me, I just want to give you this straightforward information about what's going on and how it's going to affect your portfolio in a real world sense. I don't do this for any other reason other than just give you guys information and make sure, it's another way for you guys to feel more comfortable with your investment portfolios ultimately. So, but I thought this was a good chart, just kind of looking at numbers historically too. Also, looking at this, there's not a lot of time frames where stocks are down either. So statistically speaking, on a year over year basis, stocks are up 75% of the time. Which kind of holds true throughout this time frame here. So this is kind of pinpointing a couple really good market cycles through the 90s. One obviously bad market cycle through 2000 to 2008 really was the end of the year there, but went into 2009. And then we've had a really good market cycle since then with some pullbacks along the way, obviously. But it kind of shows you the long term of why you want to stay invested. Stocks ultimately are going to be in your favor, even in years like we had during 2022 here just a few years ago. On a total return basis, stocks were down 24% at one point that year. For the year, they ended up down about 18% for the year. But then we had these last couple of years where they're up 26 and 25% last year and in 2023. So staying invested, is really the key to long-term investment success and growing your money. So getting a little bit more into the weeds on some specific things. There's a portfolio that I manage. If you have an IRA with me, you're in this portfolio to some degree. I call it the sector rotation strategy. This chart that I have pulled up here is showing the S&P 500 sector performance for 2025. The data here is as of the end of June, so just kind of semi-annual data. So a little different by the time you're seeing this, but holds true relatively speaking. But this just shows, the same kind of like what we were looking at before in the drawdowns there. This chart is showing the drawdowns of each sector so far this year, and then the overall total returns so far this year per sector. So some of the areas that have really lagged, that I'm a little bit more, I've actually added to more recently, is discretionary, which is the worst performer this year. It's had the biggest drawdown to it. A couple of the reasons for that, the largest positions in that discretionary sector, number one is Amazon. They're the largest company in the consumer discretionary segment. Obviously, if you don't, the reason it's discretionary is because typically you don't really need stuff you're buying on Amazon overall. Not that you can't get essentials and everything, but Amazon makes a lot of its money based on people wanting to spend more money. So it's considered just more of a discretionary company. Second largest in there is Tesla, followed by then Home Depot, and then there's a number of other retailers in there as well. So Amazon and Tesla have really, Tesla especially has lagged this year. A lot of it just because of Elon Musk being in the news around, the Doge, his work with Doge and all of that, and then just not having a couple good earnings reports this year. So I'm very optimistic on that making a turnaround, especially because Amazon is the largest position in that portfolio. And I think that as consumers feel more comfortable about where the economy's going, their jobs, their income, all of those things, they're going to spend more money ultimately. So that's an area I had actually added to here earlier in the month for that sector rotation strategy, just kind of taking some money away from some other winners within the portfolio. Communication service was the specific one that I ended up pulling a couple percent back to end up adding to the consumer discretionary segment. So if you're wondering how much of your portfolio is in this, if you're a client of mine and you have an IRA, minimally it's 50% of your portfolio that's in this sector rotation strategy that I manage. If not, if you're more aggressive, it's up to 100%, obviously. So if you're on the younger time horizon, probably more likely you're 100% in it, versus if you're in retirement or very near in retirement, you probably have closer to 50% of your portfolio held within that. But either way, still a large part of portfolios that I manage. And that was just I wanted to update everybody with that because that does affect, pretty much majority of you that are going to be watching this out there. So, and if you're not one of my clients and you're watching this, those are some of the changes that I make ultimately within portfolios to help take advantage of imbalances that happen, within the market over time. Because, one of the things that I'd like to do, instead of a typical advisor is going to put somebody's money in an S&P 500 index fund or some generic mutual fund, and really I look at it like there's ways that I can take more calculated risks for my clients and reduce the overall risk for the portfolio while still looking to increase returns versus just a basic benchmark like the S&P 500. So that's what that sector rotation strategy kind of is set up to emulate, but with a little bit less risk, with ideally getting a little bit better rates of return over time. So next chart that I have here is showing the likelihood of a recession in the next 12 months. So this is a chart that was created. This is a Wall Street Journal survey of economists. This just goes over what those economists think the likelihood of recession is, if they think they're going into recession or not, within the next 12-month period. So we had a really big drop off after a spike in the first quarter, which likelihood is because of a lot of these economists becoming a little bit more aware of what President Trump plans on doing with tariffs and how that'll impact the economy. So that's definitely a good sign to see that number going down. When it gets above, that 50% range is generally when, from an economic standpoint, we're not doing as well. 2022, that actually peaked right when the stock market hit a bottom for 2022, not very surprisingly. So it's kind of like a lagging indicator, meaning that as this comes out, it's really after economists are reviewing whatever the market data, is in the economy, and then they're making their assumptions on what direction that the economy is going to go. So good indicator though that it's moving down, which also the stock market in that time frame in the second quarter moved up. So not very surprisingly there. So last chart that I have is not geared towards stocks, bonds, or anything in really that I'm directly managing for anybody, but it's about housing prices and the U.S. median existing home price hitting a new all-time high. Being that when I work with clients, while I'm managing the investment portfolio, the asset that, one of the largest assets that a lot of my clients have, and if you're just viewing this out there, this probably falls for you as well. If you own a home, it's probably one of your largest assets as far as the equity that you have within the home. So definitely a good sign to see that as existing home prices are going up. That 435 in June is a national number. So if you're in the central Pennsylvania area, where I know a lot of you are, Central PA very much so tracks that U.S. median price pretty closely. So it's not too off of where if you're in that South Central PA area in Harrisburg, York, Lancaster, you're probably relatively in the ballpark of that to a degree, just depending on your area. So definitely a good sign though for the economy. If interest rates were to go down, the likelihood is you're going to see this number shoot up in a more aggressive way, because you're going to get a lot of people that are sitting on the sidelines right now back into the housing market, where they might be renting right now, waiting for prices to become more affordable because they just can't afford a monthly mortgage versus what they can afford in rent. So I thought that was an interesting chart though that affects a lot of you guys out there from a financial standpoint. So I wanted to just bring that up for you. But that's what I have here for this month. If you have any specific questions for me, never hesitate, reach out to me, call, text, email, whatever works best for you. If you have people that you think would be interested in having an investment conversation with me, I'd be more than happy to talk with them, just get them connected with me. Simplest thing is either send a 3-way text or just send me their contact info and let them know that I'll reach out to them. That's probably the simplest way to get me connected with people if you have friends or family that just want to have a conversation about where they're at. No cost, no obligation, obviously. So Just want to give them good information if you have people you think would benefit from talking more in depth with me. So, but appreciate you all taking the time to check me out. Until next time.